Hello, everybody. Welcome to Consumer Action's webinar on the impact of COVID-19 on retirement savings. My name is Nelson Santiago, and I am a Community Outreach Manager with Consumer Action. Welcome. We have a fantastic program planned for you today. Before we move into our program, let me go over a couple of housekeeping items. First, you will be in listen-only mode throughout the webinar. If you have questions for our speakers, please submit them using the question function in the control panel. My colleague Linda Williams will be monitoring your questions, and at the end of the webinar, she will present them to our speakers. If you're on Twitter, you can also tweet us your question using the hashtag CAWebinars. Also, make sure to follow us on Twitter. Our handle is @ConsumerAction. This webinar is being recorded, and you will get a link to the recording and a PDF of the slides probably by sometime tomorrow. We want to start the program today by first thanking our project sponsor, Wells Fargo. Today's webinar is presented as part of Consumer Action's COVID-19 educational project with funding provided by Wells Fargo. Wells Fargo has made it possible for us to bring you a series of educational webinars and publications that have proven very popular over the many months since the beginning of the pandemic. Joining us today is Bonnie Wallace. She might be able to give us a few remarks to join us in welcoming you. And if you're on, Bonnie, go ahead and give us the remarks now, or we will move on. Are you there? Okay, we will maybe hear from Bonnie a little bit later. Next, I want to tell you a little bit more about Consumer Action and about our COVID-19 educational project, especially for those of you who might be newer participants. Consumer Action is a nonprofit consumer education and advocacy organization. We are celebrating our 50th anniversary later this year. We enjoy a national reputation for creating multilingual consumer education materials on a variety of pocketbook issues, including various personal finance topics, insurance, housing, telecommunications, privacy, and more. We also have an extremely busy advocacy department that works to advance pro-consumer policy and legislation, and to help consumers get heard by those in power. Consumer Action also operates a consumer information and referral hotline. The hotline's been running since we first started the organization out of a church basement in the early 70s. We get hundreds of calls from all over the country every month, and consumers can find our phone numbers, and you can find the number to the hotline on every single one of our publications, as well as consumers can get to us through a link on our homepage, and the homepage is the URL is right there on the lower right of the screen. On our COVID-19 educational project page, which you can get to from the URL that you see on the lower right, you'll find links to consumer education tools that we hope you can share with your colleagues and your clients. The resources include a resource guide, which is a multilingual, frequently updated COVID-19 guide with information on everything from student loan relief to resources for small businesses, to finding help with travel disputes during the COVID era, and a lot more. It is quite comprehensive. You'll also find links to the recordings of our past webinars that are part of this project. Some of the topics have included fair housing rights, domestic violence and financial abuse, food insecurity, and a lot more. Also, we have created several new multilingual fact sheets for the project, including on topics like identity theft, estate planning, career transitioning, and more. They're brief fact sheets, about 4 pages, full of key information that consumers can put to use right away, available in English, Spanish, Chinese, Korean, and Vietnamese. So please visit our project page when you have a moment and download the materials to share with clients and colleagues. But now, without further ado, let's move into the main part of our program. First, a quick look at the agenda. We're going to start with a poll, which we call How Much Do You Know? It's based on a game that we used to play in our in-person trainings. Some of you may remember that. It was just a fun way to kind of get to know what you might already know and get you interested in learning. But unlike the live trainings, we're not going to have prizes today, and we're not going to have that heated competition you may remember where people would be vying for these prizes. So we won't do that today, but hopefully when we get back after COVID, we'll do more of that. For now, we'll just do the poll. And after that, then we'll have the presentation from our guest speakers. And then we will have a Q&A session facilitated by Linda Williams. You can send her your questions throughout the webinar. You don't have to wait till the end. She'll be gathering them and presenting them to our speakers. And then we will wrap up, I should say, with a survey, a post-webinar survey, where we will be asking you a few questions about what you learned and asking you for feedback. So please fill that out. And then now we'll go ahead then and move to the poll. And if I could get the first poll question, please. Almost 30% of older workers with retirement accounts withdrew or borrowed from an IRA or 401k during the pandemic. Is that true or false? Almost 30% of older workers with retirement accounts withdrew or borrowed from an IRA or 401k during the pandemic. True or false? Take another moment or two. Okay, if we could get the results. 82% true, 18% false. That is actually true according to a Kiplinger Personal Finance and Personal Capital survey as reported by Forbes. So most of you got it right. Let's look at the next poll. About 10% of Americans have not started saving for retirement yet. About 10% of Americans have not started saving for retirement yet. Is that true or false? Another couple seconds here. Okay, let's get the results. 68 said true, 32 said false. Okay, so this is actually false. Why? Because it's actually, the percentage is actually closer to double that. It's according to a survey by Finance Buzz, 21% of Americans have not started saving for retirement, including 45% of Generation Z and 20% of millennials. So let's move on to the next question. A 401k is a good place for workers to save for retirement when they don't have an employer-sponsored retirement account. A 401k is a good place for workers to save for retirement when they don't have an employer-sponsored retirement account. Is that true or false? Couple moments more. Okay, let's see how you responded to that. 52% say true, 48% say false. You guys are almost half and half. This reminds me of some recent votes that we've seen. It's actually false because a 401k is actually a type of employer-sponsored account. And we're going to learn about these types of accounts and others and provide lots of related resources before we're done today. So let's move on to the last poll question, please. Okay, women's ability to save for retirement can be negatively impacted by the gender pay gap, time off for caregiving, and longevity. Women's ability to save for retirement can be negatively impacted by the gender pay gap, time off for caregiving, and longevity. What do you guys think? Let's take another moment or two. Okay, let's see the results. 86% true, 14% false. And yes, that is true. Most of you got that right. And we're going to learn a lot more related to this topic today. So thank you for participating in the poll. Let's move on to the meat of today's webinar, which is our featured speakers today. We will have speaking to us today, Richard Eisenberg. He is the managing editor at Next Avenue, a nonprofit journalism website produced by Twin Cities PBS. Richard is senior editor of Next Avenue's Money channel, as well as Work and Purpose channel. Richard has helped people manage their finances and careers as a writer and editor at major media outlets, including Money, Yahoo, CBS Money Watch, USA Today, and Good Housekeeping. He has written 2 books, How to Avoid a Midlife Financial Crisis and The Money Book of Personal Finance. Richard says that he has never been interested in stories about making rich people richer. Instead, he likes to find ways to help people manage their money, make their careers better, and help them be happier. I was thrilled when Richard agreed to speak to us today. I've been a fan of his work for many years, and I've actually included links to his work in resource sheets that I've handed out at our live training. So glad that you are here, Richard. After we hear from Richard, our next speaker will be Vickie Elisa. Vickie is a financial literacy educator with Women's Institute for a Secure Retirement, or WISER. Vickie has spent 25 years reaching and empowering women regarding how to successfully navigate the economic pitfalls that create financial insecurity for millions of American women. In 2015, President Barack Obama invited Vickie to introduce him at the 10th Annual White House Conference on Aging and to share her perspective on addressing women's economic issues. That same year, Vickie was recognized as one of NPR's influential people to watch. Vickie is an Emmy, Telly, and Addy Award-winning television producer, and she has appeared in Forbes, New York Times, Chicago Sun-Times, NPR News, and many other media outlets. We were really happy that when Linda reached out to WISER, Vickie was eager to join us and be part of this webinar. So thank you, Vickie, for being here. After we hear from Vickie, our third speaker will be Dana Pollard. Dana is a managing director of investments with Wells Fargo Advisors in Minnesota. Dana has over 20 years of experience in the financial services industry. With an emphasis on professional development, Dana has earned the designation of Certified Financial Planner and also is a member of the Financial Planning Association. Dana strives to enrich the lives of her clients by building on their financial knowledge with financial structure, process, and purpose. Dana volunteers at a local church as a Eucharistic minister, and she volunteers as a speaker for the nonprofit Best Prep to further the financial education of high school students. We are glad you are here, Dana, to further our education today. So thank you for being here and welcome to all of our speakers. I will now turn the controls over to Richard so that we can hear his presentation in just a moment. Okay, Richard, you should have control now.
Well, thank you, Nelson. Thank you so much. Before I get started, I think Bonnie Wallace has joined us. Did you want her to say a few words now, or do we come back to her later?
Oh, that'd be great. Perfect timing if Bonnie can say a few words.
Oh, Nelson, thank you so much. And Richard, I appreciate just to take just a minute or a second to share that as millions of Americans face continued financial hardships due to the pandemic, Wells Fargo is working to keep families in their homes, getting relief to small businesses, helping people of color and LMI communities navigate financial stability challenges, and creating pathways to economic advancement and increasing financial inclusion. We're very pleased to collaborate with Consumer Action to provide information and resources to practitioners who are addressing the needs of some of the most financially vulnerable and are fostering an inclusive recovery from COVID-19. So, as a kind of a setup for this webinar, I just wanted to share that we're all aware that COVID-19 has wreaked havoc on both the US and global economies during the course of the last year. And from high unemployment rates to small businesses struggling and many closing, these wild swings in the stock market, the virus really has impacted all aspects of the economy. And I'm excited to hear what our presenters have to say today, really related to how all of these changes have impacted how we think about and save for retirement. So on behalf of Wells Fargo, I thank you for the work you're doing to protect some of the most vulnerable members of our communities and to enable financial inclusion for all. And I'm eager to hear what you have to say, Richard, and I'm going to pass it right off to you.
Oh, well, thank you so much, Bonnie. And again, thank you so much, Nelson, for allowing me to join you today. I've been a huge fan of Consumer Action for many years. And I love the polls that you did today and how smart the audience is today. So that was all great way to start. I'm going to try to, there we go. Oops, sorry. Well, Next Avenue, as Nelson mentioned, is a website from, excuse me, from public television. We're actually done out of the TPT station in St. Paul, Minnesota, though I work out of my home in New Jersey. We started in 2012, and our audience is people in their 50s and 60s primarily. We're trying to help people navigate their lives. And so I do that on the Money channel, which is all about personal finances, and on the Work and Purpose channel. We also have channels about health and caregiving and what we call living, which is pretty much everything else. So I invite you and encourage you to come visit us at Next Avenue, nextavenue.org. But now let me get to the subject of today, which is about retirement savings and COVID-19. So there was a recent study that came out from the Employee Benefit Research Institute. They're sometimes called EBRI, and they do this gigantic survey every year about this time, where they survey workers and retirees about their retirement confidence. And it's a really great survey to find out what people are thinking about retirement, what they're doing for retirement, what they're not doing, but maybe they should be doing, and to just sort of put your finger on the pulse of the nation as it relates to retirement. So one of the things they ask is, how much are you saving for retirement? And in the new survey that just came out, and we wrote about it at Next Avenue, they found that 27% of workers have less than $25,000 in savings, and 46% of workers have less than $100,000 in savings. And as Nelson said before, there was another survey that showed that 21% of people have not started saving for retirement at all. So you can see there are a lot of people who have not done very much saving or haven't started saving at all for retirement, and yet they need to. But now here's the strange thing, the part that had me scratching my head, and maybe you'll be scratching your head too. When EBRI asked people, so how are you feeling about retirement? Americans overall are very confident about having enough money to live comfortably in retirement. And that was true for workers, and it was true for retirees. So what they found was that 72% of workers said that they are confident about having enough money to live in retirement. And that's an increase from 69% in 2020. So even though we've just come out of a year of the pandemic, people are more confident now, workers overall, than they were a year ago about their prospects for retirement. And when they talked to retirees, they were even more confident. 80% of retirees said that they were confident about having enough money to live comfortably in retirement, and that also is up from 77% a year ago. So those are pretty striking numbers. And here's a chart that shows you the pattern. So going back to 1993, you can see it had started for workers, and the top number is very or somewhat confident. The bottom one is people who are very confident. And so the number started at 74% overall, went down to the 50s back around the recession in 2009, and then it started going up and up and up and up, and it's gone up now to 72%. And that was even true for people who said they were very confident, which started very low at 18%, but now is as high as 29%. So it's pretty remarkable, I think. So the question you have to ask yourself, and I've been asking, is this retirement confidence realistic? And I guess my answer to that is it depends. Now, there are some people who've been spending less on travel and entertainment during the pandemic. And so as a result, they have more money that they can be saving for retirement. There are some people, though, who have had the exact opposite situation. They've lost their jobs, they've been furloughed, they've lost income during the pandemic. So for those people, it's been a much rougher time than for others in the pandemic. And then EBRI also was asking people about debt. Is debt a problem for you? Well, for 54% of workers, they said, yes, debt is a problem for us. And for 34% of retirees, a smaller number, they said that debt was a problem for them. So for those people who are dealing with debt issues, and that could be student loans, it could be credit cards, it could be car loans, mortgages, personal loans, those people who are, struggling with debt, for them, confidence in retirement's got to be hard, and prospects are going to be harder because of that debt. So to me, it's a story of the haves and the have-nots. Now, a couple years ago, the Congress in Washington passed the CARES Act. And what the CARES Act did, among many other things to help people during the pandemic, was it made 401k withdrawals and 401k loans easier. Now, Nelson mentioned before, the 401ks are basically the way that people can save for retirement through their employers if their employers offer one. Now, I would say there are a lot of employers that still don't offer 401ks, particularly at small businesses. And of course, self-employed people, by and large, don't have 401ks. They can have individual retirement accounts if they open them on their own. But for those who do have 401ks, in the past, it's been hard to take money out before retirement, before you're age 59 and a half. If you did, you would pay a penalty, you'd pay an extra amount of taxes. It would be hard to even get money as a withdrawal unless you had a hardship. It was easier to qualify for a loan, but not everybody could do that. What the CARES Act did was they eliminated, for last year alone, the early withdrawal penalty for withdrawals under $100,000 for people who are under 59 and a half and were facing health or financial issues. So what they were trying to do was help people who needed money because of the pandemic, and the money they could get was in their 401k. They also, in the CARES Act, they increased the maximum allowable amount in 401k loans to 100% of your vested balance, or $100,000, whichever is less. Before that, the rule had been the limit was $50,000 or 50% of your balance. So if you needed to take out a loan last year because of the pandemic, you could have taken out more money than you would have been allowed before that. They also let borrowers forego repaying their loans in 2020, and you no longer had to take out a loan before hardship withdrawal. So those were all ways that made it easier for some people who needed money because of a financial hardship to get it from their 401k last year. So that was very helpful for some people, and I think Nelson said about 30% of people, older workers with 401ks, actually took advantage of these rules and took out loans or had withdrawals. But there's a possible danger for people who do this that I think people need to understand, which is that when you're taking money out of your 401k, which is supposed to be there for your retirement one day, you may be, harming your prospects for retirement, because at the time that you do retire, you may not have that money anymore. Now, it's going to depend on how much longer you're going to continue to stay working and contribute to a 401k. What happens to the stock and bond markets? Do you continue to contribute to your 401k? But a lot of people, once they take money out of a 401k, that money, they end up spending it, and they don't end up putting new money back in for retirement, or at least they can't replace the money that they had taken out. And so consequently, the money that they're going to have for retirement is less than they would have had before. So my caution to our listeners today is, if you can avoid taking money out of your 401k as a withdrawal or a loan, I would strongly recommend you not take money out if you don't have to, because you will need money in retirement. If you have no choice, if you need money, you're having a hard time, this is the only place you can go, by all means, do what you need to do. But if you have a choice, if you don't have to do it, I would strongly recommend not doing it. Now, there are some alternatives people may want to think about if you need money right now just to pay the bills. And you could start by thinking about, do you have some savings that is not in a retirement plan, that would not have an early withdrawal penalty, that would not have any kind of a strong tax problem if you were to take money out? So maybe you have some money in the bank and emergency savings or mutual funds. You may want to tap that before you think about tapping your 401k. You might want to even ask your employer, is there anything that you're doing to help employees who are facing financial hardship? I wrote an article for Next Avenue about this not too long ago. There are some companies, not that many, but there are some that have programs specifically to help their employees who are having a hard time right now. Sometimes they're called giving circles. And what they basically do is they have money set aside so that if you need some extra help right now, they can help you out. but it may be up to you to find out whether that's a possibility. You might ask your family or friends for help. I know that can be awkward sometimes and people may not want to do it. They may feel a little embarrassed about doing it, but if you have to do it, you have to do it. And people understand this has been a very difficult time for many of us in the past year. So I think people will be understanding if you ask them for some assistance. You could also, if you own a home, you could think about tapping your home equity line. You know, that's a line of credit that basically allows you to borrow as much as you want, when you want, and pay it back when you want. So you're not necessarily taking out a lot of money at any one time, but maybe you're taking out a little right now because you need a little right now. Some people take out cash advances on their credit cards, or they charge a little bit more. Now, I was telling you a little bit earlier to be cautious about taking on too much debt, but sometimes you need to do that just in order to pay the bills. So that's a possibility for some people. I want to say a few things about trying to stay on track or to get back on track. So, you know, this has been a very difficult time for a lot of us in the pandemic in many different ways. From a financial standpoint, I think this is actually a good time to really sit down and take a look at how you're doing financially. And by that, I mean, look at your spending. You know, making a budget, if you haven't done that before, it's not a lot of fun, but it is a way to sort of see where your money is going and are there some holes that you can plug. And you might start finding that there are some expenses that you're incurring that you might not need to. So maybe you can, you know, cancel some subscriptions or ask your utility company or cable company if you can get a lower plan, a lower price plan, or some ways where you won't be spending as much as you do right now. You might also look into automating your savings. This, I think, is a really great way to save for the future, especially for retirement. And you know, one way you can do it is if you have a bank account, you can set up an account with a mutual fund and automatically have a certain amount of money, maybe it's $50 every month, $100, $200, whatever it might be, a certain amount of money every month that will go from your bank to this mutual fund without you having to remember to do it. Because one of the hardest things about saving for retirement is remembering to do it, having the discipline to do it. But if you automate it so it happens without you even thinking about it, it's a little bit easier, and that money can really grow over time if you do it month after month, year after year for many years. I would also urge people to try out one of the many free online retirement savings calculators. A lot of the major financial services firms offer these online, and other places do too, where you can basically, you know, put in some numbers about your age, your income, your savings so far, and you'll get a rough idea of, are you on track to retire when you want to? If you're not, what do you need to do to try to get there? You know, does it mean you may need to push back your retirement age if you can? Maybe you'll want to push back when you start collecting Social Security. But these savings calculators can help give you an idea of sort of where are you and where do you need to be. And I also encourage a lot of people to meet with a financial advisor if you don't have one yet. Financial advisors can be really helpful in sitting down with you and looking at how you're doing right now, what you could be doing better, how you could be saving and investing for the future, maybe reducing debt, maybe reducing spending, and get some good ideas. You know, they know the laws, the tax laws, they understand the savings and investing market, and I think they can be very helpful. I specifically like what are called fee-only financial advisors, and especially fiduciaries. These are the financial advisors who have your best interest at heart. There are some financial advisors who will charge by the hour, and that may be a little bit more affordable for some people than the ones that will charge as a percentage of your assets. So there's all kinds of financial advisors. I recommend looking for ones that have the Certified Financial Planner designation, or CFP. There's a lot of great information that can help you to save for retirement. There are financial websites. You're going to hear from Vickie soon from Wiser, which is a terrific site about saving for retirement and all things finances, particularly for women. The National Council on Aging is a great website that has some really useful free tools that can help you find out whether there might be money that you could be getting from local utilities or state or local governments. So I recommend checking them out. Financial services firms I've mentioned have have calculators, and they also have really helpful websites often with good articles. There are media sites. Of course, there's Next Avenue I mentioned before. Kiplinger's, which Nelson mentioned, they do a great job of helping people with finances and retirement. There are a lot of money podcasts that are free and useful. I work on one that's called Friends Talk Money, which I do with Terry Savage, who is a great personal finance syndicated columnist and an author, and Pam Kruger. But there are many other good money podcasts, so I would tell you to look into those as well. And then there are some really great people on social media that you might want to follow on Twitter, on Facebook, on LinkedIn, who are experts in personal finances. And when you follow them, they will often offer their latest thinking on what's going on in the stock market, in the economy. They'll talk about articles that they've seen, articles that they've written. And I find that one way to really learn things and to keep up is by following people who know about this and who do it all the time. So those are some of the tools and resources that I would recommend. I think at this point, I'll stop now and turn things over back to Nelson, who will then introduce us to Vickie. Thank you.
A little bit of trouble here. I am now back. We thank you, Richard, for the wonderful presentation and those great resources. I will hand the controls over to Vickie Elisa from Wiser now. Vickie, go ahead and try moving the slides.
Sure, I certainly will, and it's indeed a pleasure to be here. As I was listening to Richard, you reminded me of everything that has me currently in the place that I'm in now. Grateful for experts like yourself, because I did everything wrong. I really was $30,000 in debt and was not saving and not maximizing. And of course, with COVID-19 that we're dealing with, the challenges become even more imperative that we have the tools to be able to prepare for a retirement that is going to be sound. So there are definite challenges. I am moving the mouse, and I'm going to try one more time, Nelson, in terms of getting the presentation going. And here we go. I want to tell you a little bit about Wiser. It is a wonderful organization, nonprofit, that was founded in 1996, and it provides a wealth of information to women. And for me, it was a lifesaver. As I was sharing earlier, when I met Cindy Hounsel, who is the executive director of Wiser back in 1996, I was $30,000 in debt, coming out of a bad divorce. Didn't even know I could negotiate the debt in the divorce. I just wanted out of the marriage, and I assumed all the debt. And as a result of that, had to figure out a way to work 3 jobs to get rid of that debt. But in terms of the information that's out there, Cindy has posted on the website information for women who are getting a divorce, women who are in widowhood, savings and investment, definitely Social Security, caregiving, and most importantly, retirement planning for women based on the needs of women. There are some very unique challenges we have as a gender, and that was one of the questions that came up earlier that talked about equity, pay equity, and gender issues involving women securing a sound retirement. And hopefully we'll go through what some of that information is and how women can be better prepared. Wiser also has a national resource center on women in retirement, and it's in partnership with the ACL, Administration on Aging. And as a result of that, they created a one-stop gateway. And it, again, provides that basic retirement information and resources that women need. There are also a wealth of partners from diverse groups and organizations. And there's a special focus. This is why I became involved with the work of Wiser. Most of the women that I work with in the Deep South, and I've also worked internationally, these are women who are representing low income, low wage earners, women who have limited proficiency in speaking English, and this is where my heart is at, women of color, women who are representing the Latina backgrounds, African Americans, Caribbeans. James Brown said that he was the hardest working man in showbiz. Most of these women that I know and have been very grateful to have worked with and also have been in workshops with represent some of the hardest working women that I know in terms of maintaining community and family and themselves, but yet at the end, many of them are facing precarious retirements. And with COVID-19, the challenges are even greater. Why women? There are so many more older women than men, yes. And at age 65, there are at least 5.8 million more women than men. Women make up about 67% of the 85 plus population. So there are more of us and we are living longer. I used to often say, well, if you were looking to get married, I have a lot of friends who are in their 50s and 60s and they're still thinking about marriage and getting remarried. And I had a cousin who got married at the age of 85. So ladies, it's not too late. She had 17 bridesmaids and she got married at 85. Of course, the groom was 90. So it is still not too late. So why women, even though we're facing dire consequences, there's still hope out there as exhibited by this relative. Also, the pandemic in women has created some very unique challenges. The US unemployment rate was 6.2 for Black and Latina women. It was over 8% compared with 5.2 for white females. 77% of women are mostly in occupations that require that close contact, and they can't be done remotely. And we're talking about women working in the food preparation fields, working in restaurants, working in healthcare support settings, and working in personal care services. There was also the impact of the fact that many of the schools, and I had so many women calling me, not only were they working either in a healthcare or personal caregiving field, but on top of it, when the school systems were not able to have the children in school because of COVID, many of them faced additional hardships because while some were able to slowly get back to work, others could not work because who was going to provide that oversight for the children who needed to learn remotely. And so the impact on women, especially women coming and representing single family heads of households, I have seen such tearful decisions that have had to be made around women who want to provide for their families, have been caregivers providing for their families, but have had such a tremendously difficult time navigating around the challenges of COVID. How do I still continue to work in the caregiving field when my children need help at home? There are 5 kids at home or 3 kids at home, and they still need my oversight in that home to be able for them to go to school. It's either my children's education or keeping a roof over our heads. The choices have been dire. I have spoken to women who have had to stand in food lines for the very first time in their lives. And these, if you think that these are easy consequences and that, you know, we talk about that resiliency, pull yourself up by the bootstraps, this pandemic has impacted the way women see themselves in the work field and the way that women futuristically are going to be impacted economically by this pandemic in ways that we're just now counting. There are so many other ways that I'm sure that will reveal themselves as the pandemic continues to unfold. So the pandemic and mothers, we talked about the unemployment rate for mothers living with school-aged children was 13.9% in April 2020, and it was cut more than half to 6% in January of 2021. And the percentage of unemployed single mothers by race and by ethnic groups, 9.5% for Asian, 9.3% Black, 8.8% Latina, and 5% white in January 2021. Many of the moms had to leave that workforce, like I said. Nearly 750,000, over 700,000 women had to give up on work entirely. I just spoke with a mother less than 2 weeks ago who had to leave the workforce. She was making the only one working, struggling to work. However, her 13-year-old son and her 11-year-old son, the school called her and told them that they were failing, not turning on the portal. And in tears, she came and said, I've been to your workshops. My family comes first. My children's education comes first. I have to leave the workforce. I don't know how it's going to work out for me. Keep us in prayer. But I have to be there. I cannot have my children fail school. That would make me a bad parent. And so these are the stories, hundreds of them that I have heard ever since the COVID has struck. So by leaving the workforce over the last 12 months, many of these women have lost out on job benefits such as health care, retirement contributions, most importantly, promotions and raises. So there are 7 life-defining financial decisions that Wiser has identified that can improve our future as women. And that starts with making those early short-term goals, being involved in financial decisions with your partner or spouse. Of course, Richard mentioned this, avoiding the credit card debt, keeping good credit rating, making the most of job-related benefits if they are available, carefully selecting those options for saving for retirement, and then learning about Social Security and how long your savings can last. And then future shocks such as caregiving, death, divorce, economic crisis like what we're experiencing with COVID, and then learning how to protect yourself and your family during these times of crisis. These 7 life-defining financial decisions, if you are able to have a clear understanding around all of them, can really help to put you on the road for securing a secure retirement futuristically. So women are unique, we're unique challenges. I love women. The reason is because even despite all of these challenges that we face, I call us the Harriet Tubman women of the world, resiliency. We as women have been through everything from revolutions to Great Depressions, and we still come through and still keep our families together. But some of the challenges that we face as women, we earn less than men. We spend more time away from work. Either we're the ones who are taking care of that older relative or loved one who may become ill. Many of us are in part-time work, so we work part-time. And then some of us have less in savings. We're not able to save as well, or we're not even offered the pensions. We also live longer, as I had indicated, and then a lot of us live alone in retirement. We talked about the fact that 5.8 million women more than men. So these are some of the unique challenges that we face. And as a result of those challenges, they can impact us in terms of securing our retirement. So there is total need for long-term planning. Women need to recognize what is old age going to look like for us, and I say us, in the 21st century, living to plus 100. I have a older relative. She just turned 103, and on the one hand, I was celebrating. On the other hand, all of us who are in our 40s and 50s and 60s were cringing because we're like, we do not want to live as old enough to meet Methuselah as a prospective mate. But she had reached that ripe age, And it looks like she's still in her right mind, still goes out into her garden and grows her own vegetables. And she's probably going to reach 105. And so there is a real reality of women in this country who are living into their 100s. What will your quality of life look like if you come from that family that has that type of DNA? So women will need more income to pay for extra retirement years because you don't want to outlive your assets. Women need to start saving early and to know the basic rules to succeed. You want to sign up at the workplace. I know in my 20s, as I was sharing when I saw what Richard had put up, I didn't do any of this. In my 20s, the goal was to spend money as much as possible, to max out credit cards as much as possible, and to party, 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 because you were always told you have plenty of time to catch up on your retirement. So it wasn't until I hit those 30s and I was $30,000 in debt from a bad divorce that reality smacked me in the face, and I began to save and sign up at the workplace and began to put those pieces in place to begin to say, what do I need to have a secure retirement? At age 65, women on average can expect to live 22 more years. 22 more years. So I have a lot of women that come to me and tell me these are women of color who have come to me in droves who are saying, I'm getting out, I'm retiring at 62. These have been nurses, school teachers, all of them have been so beaten down within their respective fields that physically and emotionally, they are telling me they cannot make it to their full retirement age. They have to go out at 62. And so my heart breaks, but I do understand the mental stress that many of them are experiencing. But my question is to them, can you, on the retirement monies that you receive at 62, can you make it another 20 to 35 years if indeed you come from a family where the women live until their late 90s and into the early 100s? Do you have enough assets to make it? And so that is a question that many people need to ask. If you have that person who comes to you, because I know people on this seminar do, you are having people come to you to say, I'm out at 62, I'm out. Please have them examine that question. See if there's some other alternatives that they can do to hold on to full retirement, if not retirement at 70. And I do have some women who call me, and that's the check-in point. They're 67. One was 67. She just called me recently and told me, I'm ill, I'm stressed out, but I'm holding on. I'm trying to make it to 70 because I know that I'll be able to maximize my Social Security if I can make it just another 2 to 3 years. The other thing we talked about was pay equity. When that question came up earlier in the poll, these numbers are so startling and so dire that every time I see them, and I see them in wiser publications, I'm just struck, just raw with emotion. But women earn 82 cents for every dollar earned by a man. That doesn't matter. Doesn't matter if you have your PhD, your GED, men earn more. And full-time working women earn less than their male counterparts. Doesn't matter how hard you work on the job, where you're at in that job, your male counterpart earns more. This listing shows you how the pay equity also has a bias when it comes to your ethnic background. Hispanic women earn 58 cents for every dollar earned by that man. Black women earn 63, Asian women 95, and here is when women may reach pay equity. They're predicting 2059 for women overall. But again, when you break it down by race, white women will reach pay equity. They're predicting in 2055. Black women, 2119, along with Flash Gordon, and Hispanic women, 2224. These are the years that they are predicting that women will reach pay equity. So not only are we dealing with a layer that's dealing with a gender gap of pay equity, but there is also a racial gap that is in there as well, which is frightening. It's frightening. Women in emergency savings. So 47% of women can't afford a $400 emergency expense. This is so true. So many women I know who end up with the domino effect. There's an emergency that comes up in the family, and if they could just get, and this is maybe an intervening point that can help women, is figuring out a way to get that $400 to $500 emergency expense covered so the domino effect doesn't happen and the whole house of cards will collapse because that woman can't meet that need. More than 1/5 of women, 21%, use a credit card for emergency expenses and pay it over time. I've counseled one young lady, she has 20 credit cards, 3 children, single head of household, makes $35,000 a year, and has 20 credit cards. Women turn to payday loans, bank loans, or lines of credit for more frequently than men. And women carry more credit card debt than men, 43% of women compared to 39% of men. And for Latina women, credit card debt is at 51%. 51%. So emergency savings accounts, cash can be easily accessible, but used only for emergencies. Economic crisis, job loss, pay cuts, medical emergency, or unexpected repairs. Recommended a 3 to 6 months worth of living expenses, savings, and you can do it. You can start small and build over time. You need to set up a way to work with a bank or credit union with automatic deposit from a paycheck or from a checking account. That's how I did it. If it was out of sight, I didn't see it. Remember, I used to be the credit card queen as well back in my 20s, and I was able to eradicate at that time, along with the $30,000 in debt from the divorce, all of the credit card debt at that time, and to kick off with a whole fresh new slate. You also want to continue to contribute to your emergency fund while paying down debt. I did a lot of rocking of credit cards, the credit cards that had the highest debt. I looked at the ones that had the lower debt and looked at applying that towards the higher debt cards so I could begin to rock them down. It can be done. And it also, as Richard was saying, you're just gonna have to live a little bit differently. I was a little bit tired of debt collectors constantly calling. I was tired of avoiding debt collectors. I wanted to pay my debt. I came from a family that was very responsible, that believed in paying its debt. And so just to avoid the worry of people calling you, it is such a relief to be able to get control of your finances. I cannot tell you. You don't wake up in the middle of the night like I used to in sheer panic of things falling apart. So cashing out of a retirement plan, Richard covered that. I'm not going to go through that except to go and point about the tax consequences. When you cash out of a retirement plan, it could have and still does have some negative financial consequences. And just take a look at the tax consequences and penalties for withdrawal before your retirement age or before the age of 59 and a half. You experience what they call a loss of compound interest on an account if it were left to mature. So you want to consider some of the alternative things that you can do and really think twice before tapping into your 401. I know that, as Richard said, the laws have changed. They've made it more easier for you to tap into those without the negative consequences, but you still want to think about the loss of years of compound interest and investment growth. You still want to think about that. Also, there's a retirement clearinghouse cash out calculator. It's right there if you know anyone who's thinking about doing that, because again, I am a financial advisor, but I have done everything wrong. I feel like I'm a financial advisor who had some bad financial habits, almost like I belong to Alcoholics Anonymous. but I also cashed out of several early accounts thinking that that was the way to go, and cashed out close to about $17,000. And when this was all back in my 30s that I did this. And when I look at how much I lost 25 years later, it is mind-boggling. And I could have come up with some alternative ways instead of cashing out. So please, if you know anyone who's thinking about doing that, refer them to the Retirement Clearinghouse Cash Out Calculator. That will really be an eye-opener for them. Get your stimulus check, get organized, make a list of all your expenses, including the essentials to be paid. Prioritize. We know that food, shelter, medicine, utilities, that comes first. That I have people I know who told me that the minute they got their stimulus checks, they went out and bought $600 tickets, passes to Six Flags of Georgia, saying we needed a family pass. And I'm thinking, was that really a priority? I'm talking about really prioritizing. So also contact your creditors and lenders to set up payment plans if necessary, and then prepay some utility bills. You already know who those bills are. This is not sexy. This is not fun. This is not using your stimulus to feel good. It's using your stimulus for future survival. This is survival because we're in this first leg of this pandemic, but there's no predicting what some of these variants may do and where we might be at in 2022. So this is an opportunity to use your stimulus check to get organized. Best practices with your stimulus check is take your time, don't spend it all. Don't spend it all. I'm still sitting on what was said from earlier. It's all in my emergency fund. I'm not touching it, have not touched any of it. Play it safe, pay minimum amounts on accounts, and then save portions of your stimulus checks, jumpstart or replenish your emergency saving fund, which is what I'm doing, and do not spend or invest. Keep your funds liquid because as we all know, emergencies will come up. That $400 to $500 emergency, we all know will come up. I've often found that whenever you get that extra amount of money, there's always an emergency right around the corner. Call it karmic fiscal karma, but there's always an emergency right around the corner that always takes that windfall of money and it covers it exactly, whether or not it's the car or something that needs to be fixed in your home. So sources of retirement income, workplace, Social Security, savings or earning, make a list of all of these sources of your income with your spouse or your partner and have these conversations with your partner. There are many women that have told me they're afraid to have a conversation with their husbands because their husbands or partners tell them, I handle the money, you handle looking beautiful. And I'm like, wait a minute, are we in Ozzie and Harriet land? But have that conversation, find out where the accounts are based, where the banks are based, what financial companies, what's in place, whose name is on the deed. It is not being morbid. It is, you have to explain it in a loving way to these individuals who might be controlling about finances. It's so that you don't have shock if anything happens to anyone. And you're now not only in shock or mourning, you're scrambling to find this critical paperwork, which is not the time to be scrambling for paperwork. You want to be able to look at or invest together as a couple, and if married, what happens to the account if, again, one spouse, heaven forbid, anything happen. Know what your retirement will cost, what your annual or monthly numbers are, and then figure out how much income you'll need to retire. A best guess or estimate is great, and there are so many wonderful tools that are out there. Again, retireonyourterms.org. There's a calculator tab down there. SSA, Social Security planning. They will remember when they send you out those wonderful statements, they give you the shock of saying, this is what you get if you retire at 62. This is what you get if you retire at your full retirement age. And this is what you get if you wait until 70. So SSA had that wonderful document that came out that was so helpful in planning. It's a great reality check. And then again, of course, my love of things, Wiser, your future paycheck calculator, is also available on the Wiser website. And your early IRA contribution limits per person. So this is information if you are maxing out. If you're under 50, then 6,000. If you are 50 or older, 7,000 is the max out. Social Security benefit types, these are the types that are available to you. So understand Social Security benefits and what's out there. I do think that the SSA website is very navigationable. And then on top of it, if you're able to connect with any of their agents, they're very good at explaining benefit types and what's available. Social Security retirement benefits, here you see the information. If you're retired worker benefit, you get your full benefit. It replaces about 40% of your pay on average, and full retirement, the benefit with no reductions. This is it based on when you were born in the USA. Again, I can't tell you the number of women I know that talk about cashing out at 62, and then on top of it, Social Security might be their only form of retirement. In Wiser, we talk about that three-legged stool, and we talk about the fact that you need several sources of income for a secure retirement. If you go to the Wiser website, it will provide you with a wealth of additional information on the types of product and items you need to have in place. But here's a clear example of how that retirement at 62 can impact you economically. These are just monthly benefits on average, but the early retirement at 62 is $758. The full retirement, the individual would get $1,000. But if they wait until their 70s, it's $1,320. So there is an increase if you wait until you are 70. What you also need to take into account is what I tell the folks retiring at 62, is that the health insurance that you have at 62 is going to change at 65. And so that 758 is going to probably be definitely impacted because you will be on Medicare at that time and you will be required to be on it. And so that's going to significantly impact that number. If you are a woman living alone, where are you going to live earning $500 a month from Social Security only? How are you going to pay for food, medication? I spoke with one woman who came to the workshop. She was 52 years old. She was facing a mental health crisis. She had just lost her job and she was living out of her automobile. And she was fearful that she was going to join her sister, who was homeless as well, living out of her van. These are the realities of what women are facing in America. As we continue with the baby boomers aging out, we are going to see caravans of homeless women in this country because of the fact that many of them don't have a secure retirement future, based on everything that we've shared with you, from jobs to personal practices. So tax tips and saver incentives. So you want to max out tax deduction retirement contributions, use tax refunds to start an emergency fund, beware of tax scams that commonly target older adults, and then check out Wiser's tax update fact sheet. Also, we talk about the earned income tax credit or the child and dependent care tax credit. Definitely learn about the Savers tax credit, and the Savers tax credit is available to eligible individuals who save for retirement. It works just like a federal match for retirement contributions. Eligible individuals should seriously consider taking advantage of this tax credit. So these are some of the Savers tax credit opportunities that are out there for moderate and low income workers. The tax credit for retirement savings, it works just like a match, and it's up to $1,000 for single filers and $2,000 for joint filers. And what you need to also know about taking time off when you work part-time, there are also financial consequences to consider if you have to provide childcare or elder care for parents or a spouse. Consider a spousal IRA or lower Social Security benefits. Caregivers also often have to pay out of pocket costs for that caregiving, and then how to protect your own financial retirement security. Wiser works quite a bit with women in the caregiving field, and that is because there are some unique challenges that they face as part-time or independent workers. So steps women can take, again, start saving for retirement at the earliest possible age. If you have young women in your family who are getting out there, getting out of college or getting out of workforce positions to start their own businesses, encourage them in their 20s and 30s to start saving accounts, also to maximize employer-sponsored retirement plans or IRA. Women, we're going to need more income, and we vastly tend to underestimate how much we're going to need and for how long. Again, we know that women on average live longer. At age 65, we can expect to live an average of 22 more years, and men an average of 19 years. So you really want to take all of that into account. We need to shift our thinking and to recognize what the reality of old age is like in the 21st century. Somebody told me if orange is the new black, then 70 is the new 40. I was like, it is? Well, I have something to look forward to. So working for 2 to 4 years longer than retirement age. I was just talking with a friend of mine. She worked until she was 74. And she was talking about it was the best decision that she ever made. Also looking at long-term healthcare costs, and the biggest risk for women is really outliving those savings and assets. So that is really essential that you really try to calculate based to the best of your knowledge. The best time to claim, again, Social Security and employer-sponsored retirement plans, and also allocating some of those assets to lifetime income annuities. So financial do's and don'ts for the decades in the 20s, here we go. I'm not gonna read through it. I'm gonna really focus, but this is everything that I didn't do in my 20s and 30s that we're encouraging you to do if you are in your 20s and 30s listening. This is getting a little bit closer to a lot of the women that come into my webinars and conferences now. A lot of the women are in their 50s. It's amazing how suddenly when you turn 50, you want to start talking about retirement. That is amazing, and they're really recommending that you really should have those conversations beginning in your 20s and 30s, but it's still not too late to prepare in your 40s. Run retirement projections and set up specific goals, max out retirement account contributions, and do not push the pause button. You're in full throttle. And in 50, it's full throttle on steroids. Upgrade your skills needed for employment, because ageism is a real thing. And what got you through those great jobs in your 20s, 30s, 40s, and 50s, if you have to find a new job in your 50s, ageism is going to hit. So you really want to upgrade your skills and don't have any excuses on that resume why they don't think that you're capable of competing in today's marketplace. So take advantage of higher contribution limits, compare savings to goals, and get documents in order. Check beneficiary designations to make sure that you have everything legally where it needs to be. And then, of course, 60s, consider your retirement spending strategy, review retirement accounts distribution requirements, create estate plans, review desired retirement age and Social Security claiming, and consider options if you can't afford to retire, and then review Medicare options and choices. And again, I want to thank you so much for allowing Wiser to be a part of this workshop. I hope the information is useful to everyone. If you have any questions, please contact us at Wiser. There's the telephone number. And of course, always like us on Facebook and follow us on Twitter. And with that, I will turn it back over to you, Nelson.
Thank you very much, Vickie, for that wonderful presentation and all those anecdotes and real life stories that we can all learn from. Let's move on to Dana Pollard. Dana, if you're on, you can go ahead with your presentation.
Thank you so much. I appreciate it. Great information shared by Vickie and Richard. And I just want to add a couple of things on a personal level on how, when we look at the data and we look at the statistics, how we can really look at our own situations and take power over that. It is overwhelming to look at the debt loads, and it's overwhelming to look at the inflationary numbers and how much we really are going to need. We're going to live a long time, and we are going to need more assets than we can even fathom to be able to do that comfortably. And when we deal with the pressures that are on us, the lack of ability to work in some situations, the force out of the job market in some situations, it becomes very difficult. And so it's critical that we start with baby steps. And the first thing that people need to do is really take a look at how much they have in their bank account, how much you are bringing in, how much you're earning, and then also look at your expenses. This is the number one challenge that we have in working with individuals and families, is people simply don't know what it costs them to live. And it is really not the most exciting thing to take a look at, but I would strongly encourage people to take a look at not only what they are spending in general, but to break it down. What is necessary? What is discretionary? And what is hopes? What are the hopes and dreams? Because once we have the necessary, then we can move on to the discretionary, the things that are a little bit more fun, that make life a little bit more comfortable. And then we can move on to the dreams. And when we understand how much money we absolutely have to live and how much money is coming in, then we can determine how much we can save. And it is critical, as has already been mentioned, that we pay attention to debt. Debt is so harmful, not only from a financial standpoint, but emotionally, it is what suffocates individuals. People get demoralized by having debt, and it's almost impossible to move beyond that until the debt is gone. So taking a look at the debt and reducing that in any way possible is important. Secondly, to increase the amount of money in savings. We all need a slush fund. Emergencies happen, life happens. And so to have some money that is in a savings account that we can count on, rather than going into debt, to have that savings will protect us from doing so. And then beyond that, investing funds. So being debt-free, having a savings balance to handle emergencies, and then starting to invest for retirement is such an important next step. Oftentimes people do not invest for retirement because A, they don't have enough money. Second, they don't know where to start. And so knowing where to start is critical. There are great resources out there. Many of them have already been mentioned. In addition to those, I would suggest that employers have resources, starting out with an HR professional or somebody at the business that you work in. There are great opportunities there. There are people at banks and credit unions, investment firms. We are willing to help and wanting to help. There are also some fantastic online resources. The most important thing, though, is to not let your emotion get control of your finances. It is up to us to handle the money, not the money to overwhelm us. And people oftentimes don't invest because they're scared or they're confused. And we need to break through that confusion. We need to break through that sense of, what do I do? It's too scary. I can't handle it. People will often blame the markets for, well, I don't want to invest. The markets are high. The markets are scary. There's too much risk. It's like gambling. All of that is untrue. The markets are actually very systematic. They are very available to everybody. Investing is something that everybody can do. Again, I encourage people to first pay off debt. Second, have savings balances. But beyond that, to invest funds for the future. It is the only way to grow money. I have young children, and when I teach my children how to handle money, I remind them that if they invest it, the only thing they need to do is wake up in 50 years and then spend it. They don't have any other requirement. And so investing well and using good resources to invest in a way that is safe and will ensure growth is critical. People can use IRAs. There are Roth IRAs and traditional IRAs. Roth IRAs allow people to put money away that is already had taxes paid on it, and then the money grows tax-free. It is a huge resource for many people to use. Traditional IRAs are monies that can be put aside and then the tax is deferred and paid at a later date, which allows the money to grow in the account, and then later, when potentially there's a lower tax bracket, the money is taken out. 401ks are options for investing in corporations that offer them, and then 403bs are available for people who work in nonprofits oftentimes. And so there are retirement vehicles available for every type of investor once people determine how much they have to invest. And that really does, again, start with understanding how much you're spending, how much you need to survive, how much you need to thrive. And then beyond that, what do you really want in the future? So setting goals around your financial future is critical in determining how to go forward. It is important that people do not get in over their head around advice. And what I mean by that, the studies show that men and women have different money personalities. Men tend to be more impulsive around making money decisions. They act and they go. Women tend to gather a lot of information. We talk to our neighbors, we talk to our sisters, we talk to our best friends, we talk to the guy on the bus, and we don't do anything. And both of those different money personalities have different risks involved. Women who gather a lot of information sometimes don't act, and it's important to actually make a decision and move forward. Men who act impulsively sometimes make bad decisions and then are stuck with the consequences of that. So we need to take a look at what the options are and save appropriately, invest appropriately, and don't let the emotion take control. It is very, very easy to find great information around how to invest and how to save for retirement. But it starts with looking at your own personal situation and determining what's right for you. So I encourage everybody to understand where their debt is, and if there is debt, to work on a plan to eliminate it. Secondly, get savings, have a slush fund so that when emergencies do happen, and they always do happen, that you have something to fall back on. And then finally, figuring out how to invest for retirement. It is not exciting. It is not fun. It is absolutely necessary, however, to start saving for retirement. I recommend that people save at least 10% if they can, again, without going into debt. If you can do more than that, that's fantastic. It really does depend, though, on your personal situations and how much you can afford. In terms of savings balances, I love to see people have 2 to 6 months of what it costs them to live. So if you're living on $2,000 a month, it's great to have $4,000, and it's hard to get there. It's hard to start. So if nothing else, just start. Start looking at the numbers. Start looking at what your spending currently looks like, what is being used for necessities versus what is being used for the stuff that's fun, and then figuring out where the gap is and how you can save for your retirement, because you're worth it. It's worth saving so that you can have that security and so that you can have the things in your retirement years that are fun. It's both about security as well as freedom. So look at your own money, understand what your resources are, reach out to advisors. We're here to help you. We want people to succeed. Again, whether they're online resources or people in person, there are fantastic opportunities out there for your financial success and well-being. Thanks, Nelson. I'll turn it back to you.
So much, Dana. I'm going to put the slides back up. And we want to hear from Linda Williams if we have questions for our wonderful speakers today. Go ahead, Linda, if you're on.
Thank you, Nelson. Before I start, I want to thank Richard, Vickie, and Dana for those great presentations. Do we have questions? Yes. And they're coming in faster than I can type. Let me start with the first question. And you probably have discussed this, but it's worth mentioning, giving them the answer again. We have the following question coming in from an attendee, a guest in Fresno, California. I am getting a divorce after 18 years of marriage. I've worked off and on over the years, but I don't have a retirement account or an advanced degree, and I'm currently unemployed. Do you have any tips for me?
I'll be happy to start. First of all, I'm so sorry to hear that you're unemployed, and I wish you luck finding a job. That's going to be the first priority, certainly both for income and also for then the ability to possibly save for the future. We've talked already about looking for ways to cut expenses. That's not fun to do. It's not easy to do, but it may be something that you really need to do. And this may be a time to look at your credit card debt and see if there's a way that you can reduce that, maybe working with a credit counselor who might be able to help you. And let me see if the other panelists might have other things to add.
I do. This is Vickie. I would also recommend, just as Richard said, you're taking a look at the debt that you have, but you also want to take a look at the assets, any assets that you and your spouse may have, because you want to ensure that there is equitable distribution of those assets. In addition, you said that you were unemployed, but if your spouse was working and you were married for 10 years or more, does he have a pension? And you want to ensure that as a part of any type of divorce proceedings that you are eligible for his pension, if he indeed has one and you were married for over 10 years. You also, if you were married for that time as well and don't get remarried, there's also some maximization that you might be able to do in terms of your Social Security dollars being his Social Security dollars, in terms of you getting the higher pay for Social Security since you were not in the workforce. So again, look at the assets, look at fair, equitable distribution, look at potential of pension, and then also look at what his Social Security might look like in comparison to your Social Security. And if you're able to, ensure that you get some legal help to help navigate, and definitely take a look at Weiser's website. There's a whole section on divorce that will offer you a wealth of other information that I might have missed some elements that you definitely will give you some food for thought in preparing for your future.
Great. Dana, do you have anything to add to that?
The only other thing that I would mention is divorce is not financially beneficial for families. You're taking one household and creating two, and it's important that you advocate for yourself. Start by understanding where all the dollars are. Those must be disclosed. And again, use resources, legal resources, and as well as financial resources. People can help you understand what you have and also what you are entitled to.
Great, thank you. And there, as Vickie mentioned, there's a fact sheet on divorce and retirement that was created by Weiser, and it will be in your handouts that you will receive a link to tomorrow. I want to welcome to the webinar Atlanta, Georgia. We have the following question from an attendee, a guest in Georgia. What are the pros and cons for working past age 70? And does it increase the amount of Social Security benefits? And I think, Vickie, you talked about this a little bit, a framework in the 74.
I did. The pros for me is the fact that it does increase your Social Security. So I'll leave it at that and open it over to Dana or Richard if they have anything else they want to add. But that's the pros for me.
I would add that after age 70, at retirement, there are a couple things that happen. People stop saving. They also start spending from their assets. And so the longer people can work, the more that can accumulate and the more freedom they have. The risk, of course, is health and the ability to work. We do see people planning to work oftentimes till 70 and being unable to. So although it's great to have that goal, the longer you work, absolutely the more financially beneficial it's going to be. It's also important to save as if that might not be possible. So save as much as you can.
The only thing I would add to that is if you continue to work past 70, you may be able to continue to save for your retirement. I know people sometimes think, well, gee, if I'm in retirement, I don't need to save for retirement. But the truth is, if you can keep saving, it's going to be helpful for you. A lot of people at that age who want to continue to work find that it's very hard, if not impossible, to get hired by an employer because employers discriminate against older people when they're looking to hire many times. But a lot of older people are starting to turn towards entrepreneurship and starting their own businesses. And that could be working from home in the gig economy. It could be working part-time, being a consultant. There's lots of things you might be able to do. So I would say if you're healthy enough and feel able and interested enough to continue to work, that's great. You may want to end up thinking about doing that for yourself.
Great, thank you, and thank you, Georgia, for that question. We have the following question coming in from attendee, a guest in Oakland, California. Is it better to invest pre-tax or Roth 401 or split? And if I already have a 401k with my employer, should I look at investing in a mutual fund?
Great questions. And the answer is it depends. So if you are maxing out employer retirement funds, it is a fantastic idea to also have money that you're investing after tax because it creates flexibility around spending that money without penalties. So perfect world, people would be able to max out their retirement plans at work as well as be investing into mutual funds, ETFs, or other types of things outside of retirement plans. Roth 401ks versus traditional 401ks. Roth 401ks allow people to put money in after tax. It grows tax-free. In retirement, you can take that money out and you do not pay taxes on those funds. They are fantastic. So for people who have Roth 401ks available or for people who are contributing to Roth IRAs, that is a fantastic resource and frankly my favorite type of account when it is available to people. Traditional IRAs allow people to put money into their retirement savings with the taxes deferred. So upon retirement, when people are using that money, they do have to pay income tax at potentially a lower tax bracket because they're no longer working. So the mix of how much to Roth versus how much to 401k does depend on people's tax brackets and how much they're wanting to pay now versus later. And oftentimes an accountant, a CPA, or financial advisor can help you crunch those numbers to determine how that's going to affect your paycheck. But in a perfect world, a Roth 401k plus money outside of a retirement plan can be beneficial to people long term.
Great. Vickie or Richard, you have anything to add to that?
I guess I'd add two things. One is the limit on how much you're allowed to put into a 401k is very high. It's $19,500 if you're under 50, $26,000 if you're over 50. So for most of us, we can't get anywhere close to having enough to be able to get to that maximum. But if you can, congratulations on that. The other thing I would say is the one reason you may think about investing outside of your 401k is that you may want to be investing in certain types of investments that aren't offered through your 401k. Now, every 401k has its own investment choices, and some of them have many choices, some of them don't. But you may find that they only offer you a choice of between A and B different investments, and you may say, well, you know what, I'd like to put a little bit of money in international mutual funds or the stock market or something that isn't there, maybe something safer, maybe something riskier than what they're offering. So going outside your 401k may open you to some other possibilities that you don't have with your 401k.
Great.
And I'll just add the wiseism that my grandmother said, don't put all your eggs in one basket. You want to have diversity, and that's what I'm hearing from the wisdom that's coming from both Dana and Richard is diversity is good.
Great, that's good advice. Thank you. We have a question, a really interesting question from a guest or attendee in Alabama. It's kind of like a double whammy, so I hope you're ready for it. What should I look for when choosing a financial advisor, and where do you go for financial advice if you're struggling to make ends meet?
Dana, do you want to take that one? I know my advice when people ask me, who should I look for in a financial advisor? I often say, look in the mirror and initially look to yourself because you want to find out as much as possible. Financial advisors come in many different packages. And so my first recommendation is to actually look at what are the various attributes of financial advisors, even if you have limited funds, to understand the distinction between the types of services they provide and what they're able to do for you. So get informed first about what happens in that field before you decide to select someone.
I agree with that, as well as a couple of things that Richard said earlier in the webinar, which is there are different levels of responsibility that financial advisors have for people. So there are those of us who are certified financial planners, who have the designation from the Certified Financial Planning Association. We are fiduciaries by virtue of what we do. There are other people who have fiduciary responsibility by the types of accounts that they manage. And so understanding the different types of financial advisors is also important. On a basic level, what I would suggest is starting with the people most accessible to you. So if you're feeling like you need advice and you just don't know where to go to your financial institution, go to your bank, go to your credit union, and ask them if they have resources available. If not, go to community resources. There are a lot of resources available. Understand the credentials that the people you have are working for, and make sure that they're looking out for your best interest. That really is the most important thing. And to some degree, it's like dating. We all go on that first date and we think, that sucked. I'm not going to do that again. If you get that feeling from the first person you talk to who says they're a financial advisor, don't go back. Follow your gut. Your gut will tell you whether that's an appropriate person for you to work with, whether they have your best interest in heart. If you go on that date and you think, I really like that person, I feel like they heard me, I feel like they understand me, I feel like they have something to offer me, then go on the second date. It is important that you trust the person that you're working with and you know that they have your best interest in mind. Most financial advisors who are really focused on helping people succeed financially will help people at a lot of different levels of resources. And so don't let not having money limit you. There are people out there to help you. They will do it pro bono if they can, and if they cannot, they will find somebody to help you do that.
Great, thank you.
Those are all great points. I agree with everything they've said. I would just add to that. The one thing you may want to do when you're looking for a financial advisor is, as you search online, there are lots of directories of financial planners. See if you can find ones where they tell you whether that person has any kind of expertise or area that they particularly focus on, because you may then be able to find people who work with people just like you. Some financial advisors specialize in helping small business owners. Some work a lot with divorced and widowed people. So you might want to try to find somebody who has a lot of clients that are just like you. And then that gets back to what Vickie was saying about compatibility and how you're going to feel with that financial advisor. So have a free consultation with a financial advisor that you think you may want to talk to. Could be by phone or by Zoom or maybe in person these days, depending. And then you want to see just sort of how comfortable do you feel with that person or do they feel about money the way that you deal? They may be riskier than you might feel about how to manage your money. And that's not going to be a good idea for you. You want somebody who's going to be comfortable dealing with your money the way you would want to do it. If depending on how much expertise you have, if you feel like you have a lot to learn, you want to find somebody who's going to be comfortable and interested in educating you. And some advisors are going to want to do that and some are not. So you want to find the right person for you, not just the person who's going to make more money for you, which would be helpful, but you want to find somebody who you can work with.
Great. Thank you. Now we have a question coming in from Alabama and Maryland, and they're both similar. Our guest from Alabama is asking the question. She's saying many employers have instituted pay cuts that limits a worker's ability to contribute to their retirement plan, and some employers have even stopped paying match funds to retirement account. And our guest from Maryland is saying that her employer no longer contributes a match, and should she keep her 401 account or should she just let it go? I think she's had it since 2004, and Alabama is asking, how can we get back to saving for retirement under these situations?
I'll start and say, I'm sorry to hear that that employer is not matching contributions anymore, and I hope that changes. It is happening at some employers, though not as many as in the Great Recession. But I would say that should not be a reason for you to stop contributing to your 401k. You should, you have to put yourself first, and you need to continue to save for your retirement, even if your employer isn't going to do it for you to help you out. Be sure you do it on your own. And in fact, it may be even more important for you to do it because you now can't count on money coming in from the employer. So if you can afford to compensate for that, you should. But if you can't, then put in as much as you continue to. That's what I would say.
And I would say the vehicles that you can use if you are not able to contribute to a retirement plan through your employer include potentially, depending on your circumstance around how much you earn and your tax situation, Roth IRAs, traditional IRAs, as well as just after-tax investment accounts. There are resources, and I would echo the importance of continuing to put money in somewhere, if not through the employer, through something that you can control on your own.
Great, thank you. We have a question coming in from Garden Grove, California. For people that are in their late 50s or early 60s, is it beneficial to open a Roth IRA?
It absolutely can be. It's a way of continuing to save, first of all, to invest that money and allow it to grow without taxes on that money. And so regardless of age, certainly starting it in your 20s is ideal. Very few of us ever had that foresight. But even at 50 or 60, contributing to a Roth IRA, if you have money that is going to be longer term, if you think about even 10 years, how much money can grow when taxes are not being taken out, that's a phenomenal power. And so Roth IRAs are a good avenue of investing regardless of age.
I agree. They are great vehicles for doing that. And again, you know, as shown in that particular slide, even in your 60s, you should still be, if you haven't taken those steps, you should still be taking those necessary steps to try to move forward to securing that retirement, even in your 60s.
Great, Garden Grove in Alabama. Thank you for those questions. We have a couple more. I want to welcome to the webinar Florida. Our guest in Florida is asking a two-part question about a new California law. California has a new law requiring employers that do not already sponsor an employee retirement plan to participate in a state-run retirement program. Will this law really benefit workers? And to your knowledge, are other states following California?
I'll start on that. I think it's a great thing that's being done there, and it is happening in a few other states around the country. And the reason I like it is because there are still so many people who are working at employers that do not offer any kind of retirement plan. And it's hard for people who don't have a 401k at work to have the discipline and the initiative to go out and save for retirement on their own. So if there's a state-run program that basically will create the equivalent of a 401k for you where you can then save for the future, I say absolutely take advantage of that if your employer is not doing it.
Great, Dana, anything to add?
I concur.
Thank you, Vickie.
I would just add that, especially as Richard was saying, that many, especially working women, are often not even offered, they're not in the position within that company or corporation or entity for even being offered any type of employer matched funds. And so entities like what's being created in California are great avenues for people who've already, you know, not had the opportunity to be offered to be able to at least create opportunities for retirement saving through those sponsored entities.
Great, thank you. We have a couple more. This is a really, really good question coming in from Los Angeles. Welcome to the webinar, LA. Our guest from LA is asking a great question today. She is asking if you could briefly explain why preparing for retirement should also include preparing to live or remain independent as long as you can.
Well, definitely. I mean, we know that as we talked about the issue for women outliving their assets, and Dana also mentioned the fact that even if you are trying to work into your 70s to maximize your Social Security, there are mental and physical health impairments that may prevent you from having healthy retirement or healthy aging. And so at the same time that you are also looking at making wise investments in your future retirement economically, you should also be looking at wise investments in your health, maximizing, again, all of those preventive services that are out there to ensure that you are remaining healthy, getting adequate exercise, nutrition that you need, and that you are getting the preventive screenings that you need to rule out any future chronic diseases. So health and wealth are hand in hand.
Great.
I just add to that we did a episode on the Friends Talk Money podcast, and then an article on Next Avenue all about the importance and idea of trying to remain independent for as long as you can, and how to do that. And partly that comes to the idea of aging in place, which is something a lot of people say they want to do. They want to stay living where they are as long as they can and not go into a nursing home or assisted living facility if they can avoid doing that, which is a great idea theoretically, but the reality is challenging for a lot of people because many people live in homes that aren't set up to age in place because they have a lot of stairs, or they aren't set up for, if you have mobility issues. So you may want to make your home more able for you to age in place, which couldn't cost some money. It's expensive sometimes to do these kinds of things. Now, there are sometimes programs that local companies will offer, or the state and local government might offer, to help you age in place. So I would encourage you to look into those. The National Council on Aging or your area agency on aging might be able to tell you more about that too. And the last thing I would say is to keep up your networks. And I don't mean work networks, I mean support networks, friends and family, people you can depend on and enjoy spending time with as you get older, because the more you have that, the easier it's going to be to remain independent, because if there will be a time where you need a little help, you'll have somebody who'll be there to help you out.
Great. And our last question is, what are the pros and cons of putting 10% of one's paycheck in a bank savings account?
Well, the pro is that you are saving money and you can accumulate it there, which will allow you to stay out of debt and have money to pay for the unexpected things in life. The cons are limited. Occasionally, we'll see people who have so much money in their savings accounts that they just don't know what to do with it, but I got to tell you, that's pretty unusual. Most people don't have that issue. There is a point, though, where we look at how much money is in savings, and once there's quote-unquote enough to kind of handle the day-to-day emergencies, then it's prudent to look at, should we be investing that excess beyond what is necessary for emergencies in something that's a little bit longer term. So if you think about investing as a funnel and the money coming through the tip of the funnel, we want to have that savings account being there for those emergencies. But on top of that, we look at retirement as well as just expenses that we can invest for in 10 or 20 years, not necessarily in 30 or 40 years. So there's very little downside to using a savings account other than just making sure it's efficient for the time frame that you are investing for, whether that's longer term, maybe moving it out of savings into something that's going to grow for you more. But for keeping the savings account for short term is critical.
And I'll just add to that, there are three pros that come to my mind and one con. The three pros are, if you're putting money into the savings account in the bank, you're not going to be losing money, you're going to be earning money. Unlike if you were to put money in the stock market or the bond market, there's a chance that you could lose money. There's also a chance you could make money, but at a bank, there's no chance you're going to lose money. Second thing is, the money is going to be federally insured, so you don't need to worry about that part of it. And then the third is, it's easy to get, so that if you need to take money out, you can do so without having to pay a penalty. The big con right now is the interest rates are so low at banks that you're not going to be earning very much money in a bank savings account these days, because interest rates are so low, and it looks like they're going to stay low for at least another year or two. You might earn a little bit more if you were to put money into a bank certificate of deposit, but when you do that, you're locking your money up for a period of time, maybe 1 year or 2 years or 5 years. So while you'll earn a higher interest rate, it's money you really can't get your hands on during that time unless you have to surrender a penalty to do that.
Great, thank you. Thank you, Richard, Vickie and Dana for hanging in there and answering all of the questions. Nelson, I'm giving it back to you, old man.
Thank you so much, Linda, and thank you to the speakers for being so generous with your time. I know we've gone a little bit over. I just have a couple slides here to once again say thank you to our sponsor and remind all of you to visit our project page to download the materials and share them with your clients. And also just a reminder, Consumer Action is a 501c3 nonprofit, and we do rely on donations and support from anybody who would like to support us. So no amount is too small or too big. You can donate online or by US mail. We love getting mail as well. Thank you again for all your time to the participants and to the speakers. Until next time, stay safe and goodbye.